When it comes to investing in the stock market, it is widely believed that expertise is required to build a strong portfolio. The assumption is that success depends on picking winners, timing the market, and constantly adjusting positions. But what if a solid portfolio could be built using just 4 investments? A structure designed not only to grow wealth, but also to protect at the same time. The mainstream approach to portfolio construction typically follows the classic 60% stocks and 40% bonds model. However, this approach is often presented as a standard without questioning its effectiveness. The bond allocation can include corporate bonds, mortgage-backed securities, and is generally centered around U.S. Treasury bonds. These are considered to generate interest income and are often labeled as risk-free. In simple terms, 40% of the portfolio is assumed to be safe within bonds. This assumption, however, does not fully account for inflation. Fixed income investments gradually lose purchasing power over time. That safe 40% may not be truly risk-free. If the actual rate of inflation exceeds the interest earned, purchasing power declines. With treasury bills and bonds typically yielding around 3 to 4%, and when held outside of retirement accounts, these returns are pre-tax, further reducing real gains. The focus here is on what can be considered a more optimal and ideal approach. This refers to viewing all paper investments as a single, unified portfolio. It includes the combined value of 401ks, 403bs, IRAs, and taxable brokerage accounts. It does not include a primary residence, rental real estate, physical precious metals, 529 plans designated for education, or HSAs intended for healthcare. With that framework in place, the portfolio is structured as follows: 50% allocated to S&P 500 index funds or ETFs, 10% to international stocks through an index fund or ETF, 20% to gold, and the remaining 20% reserved as an opportunity allocation. Just 4 core components define the entire structure. The strategy becomes clear when broken down to its core, yet many tend to overcomplicate it. It begins with the foundation, the S&P 500, making up 50% of the portfolio. Half of the allocation is directed into the S&P 500 through an index fund or ETF. This serves as the base because selecting individual stocks is unnecessary. The S&P 500, through these funds, already handles that process. Companies that decline are removed, while stronger ones are added. As a result, the portfolio consistently holds leading companies across multiple industries, capturing long-term growth without the need for speculation. Next comes international exposure, accounting for 10% of the portfolio. This is often overlooked, yet concentrating 100% of capital in a single country, even one as strong as the US, still carries risk. Different countries move through different economic cycles. This allocation introduces global exposure, diversifies currency risk, and reduces reliance on a single economy. The goal here is not to maximize returns, but to steadily reduce risk over time. For international exposure, a fund or ETF is used, ideally one that includes both developed and emerging markets. Developed markets represent stable economies such as Japan, Germany, the United Kingdom, and Canada. Emerging markets, on the other hand, offer faster growth but come with higher volatility, including countries like China, India, Brazil, and South Africa. This combination ensures automatic diversification across regions, industries, and currencies. At this point, the portfolio begins to take a different shape. Around 20% is allocated to gold, a component often overlooked in traditional portfolios. The reason is simple. Gold functions as an insurance policy. When currencies weaken, gold tends to benefit. This allocation is not focused on growth, but on protection. Consider this perspective. When a gold coin is purchased and held, it remains a single coin even after 5 years. It does not generate additional coins or actively grow. However, its value is likely to increase over time, as it takes more devalued currency to purchase the same amount of gold. This occurs due to ongoing money printing and inflation. While governments and central banks can produce unlimited currency with no intrinsic backing, gold itself cannot be created in the same way. The final 20% represents the opportunity segment, where calculated risks can be taken. This portion may be allocated across assets such as silver, copper, uranium, oil and energy, tech stocks, REITs, real estate investment trusts, Bitcoin, crypto, cash, or fixed income, while avoiding treasuries or using a combination of these options. These are simply examples. This does not imply reckless speculation or unnecessary losses. Instead, it highlights that personalizing a portfolio with high conviction positions can be reasonable. However, one rule remains critical. Keep all speculative exposure within this 20%. There is a clear distinction between disciplined investing and gambling, and this structure allows risk-taking without putting the entire portfolio at risk. A critical question arises: what does this type of allocation actually achieve? It delivers growth through stocks, protection through gold, and diversification by adding both international exposure and commodities. It also provides flexibility through opportunity buckets. Most importantly, it helps maintain consistent investment over time. Attempting to time the market is not the approach here. A long-term mindset with continuous investment remains the focus. Market fluctuations are inevitable, but the overall system is structured for upward movement. This is driven by ongoing money printing, currency created without tangible backing, which leads to inflation and ultimately rising asset prices. Consider this carefully. When a stock market crash drives prices down, central banks and governments respond. They intervene, inject liquidity, and print money, leading markets to recover and eventually reach new all-time highs. This is how the system operates when viewed logically. Would the median home price ever return to around $50,000 as seen in the 1980s? Clearly not. Would a new car ever drop back to $15,000 like in the 1990s? Again, no. So why would stocks, gold, or any other asset fall by 50% and remain there indefinitely? That outcome is unlikely. Inflation and continuous money creation increase the supply of devalued currency. As a result, prices adjust over time. The system moves through cycles of ups and downs, but long-term participation remains essential. Why do most people fail to build a strong portfolio? The strategy itself is relatively simple, but the real challenge lies in behavior. During downturns, panic takes over. Attempts are made to time the market, money is withdrawn too early, or the process never begins due to the belief that investing is overly complex. In reality, the difficulty is consistency and discipline. At times, less proves to be more. Simplicity often delivers better outcomes. For those constantly watching their portfolios, the urge to buy, sell, and constantly adjust positions becomes strong. However, without proper understanding, this behavior introduces significant risk. Most standard portfolios follow a familiar structure: a heavy allocation to stocks, the inclusion of bonds, typically dominated by US Treasuries, and little to no exposure to gold. The reason behind this approach is straightforward. The system is built around financial assets, not true protection. The reality of the situation is straightforward. Bonds are often considered safe, but in inflationary environments, they lose purchasing power, while gold is frequently overlooked because it does not align with Wall Street profit narratives. The result is that most industry portfolios are designed to follow the system, not to provide protection or maximize intelligent growth. This approach takes a different direction by avoiding reliance on a single outcome. It is structured to handle multiple scenarios, recognizing that future conditions are uncertain. During periods of growth, stocks are positioned to perform. In cases of currency debasement, gold acts as protection. For emerging opportunities, a portion of the portfolio captures potential upside. This creates a more balanced and diversified structure. In the end, building wealth does not require complexity or constant trading. A simple structure, combined with discipline and time, is sufficient.
And if this gave you a clearer, simpler way to think about investing, consider subscribing to the channel. That way, you stay connected to more practical, no-nonsense strategies like this, focused on real results, not complexity.